So good afternoon and welcome to Cumberland's Spring Quarterly Market Update. My name is Gerry Connor. I'm Chairman of Cumberland Private Wealth, and I'm going to moderate today's meeting. I'm joined by Peter Jackson, our Chief Investment Officer, Phil Delorio, who is head of our U.S. and international team, and finally, Diane Pang, who is lead on our fixed income. At the conclusion of this presentation, there will be an opportunity for questions. This can be done by raising your hand electronically. By clicking on the hand on your screen, we'll put you into a queue where you'll be called upon to ask your question, or you can type in a question at any time during the presentation for our panelists to answer, which Charlie Sims will then read. Now, right now, you and I are living through the sharpest economic contraction that we'll ever experience in our lifetimes. The nightly news is crowded with stories about the pandemic and failing businesses. Yet the markets don't seem to reflect this generally disturbing news. From the market's perspective, the battle is being fought on three fronts. There's a financial front, there's one on the health side, and there's an economic one. The first two, things are improving, which is being reflected in the market. The Federal Reserve has delivered an enormous stimulative package to sustain liquidity in the financial markets. In the most basic sense, the ability to get a loan or credit is the lifeblood of the economy, as opposed to what has happened in earlier depressions, where credit wasn't available at any price. On the second front, there isn't a cure or vaccine for COVID-19 yet, but we're getting closer with news of treatments and possible vaccines. On the economic front, we're into the depths of it, and we're now looking at the other side as businesses start to reopen and government stimulus packages bridge us over the shutdown. You got to remember that the stock market is a leading indicator. It's usually about 3 months ahead of the economy, while tonight's news is at best a coincident indicator. For sure, we're making progress on all three fronts, as you see in the market rally on hopes for a vaccine or as stores reopen. Has the market properly calibrated this news? Well, that'll depend on the shape of the recovery. And people see everything from a V to a W or an L, even a Nike swoosh or a square root sign. The opinions are endless, but fortunately the main difference between all of them is only the velocity and the duration of the recovery, not its likelihood. Trying to quantify and make sense of all this is our job. The roadmap for this explanation is in today's agenda. What we're going to do is we're going to look at the market environment generally and in Canada specifically. We'll talk about the U.S. market environment, some of our investments there, and we'll wrap up with a discussion on our fixed income. Following that, there will be a question and answer session. So now let me turn it over to Pete Jackson. Pete, a lot's been going on since our last client quarterly on March the 3rd. Can you please update us on the analysis that you've been conducting during the recent market downturn?
Sure, Jerry. So we entered this new decade and year with an optimism for equities amidst easing trade tensions with China, full employment, and stable growth outlook. However, as indicated in this first chart here, over a short period of time, about 33 days, we saw an unprecedented drop in the S&P 500 and the TSX of approximately 34 and 37% respectively. As the coronavirus spread from China, where it was first seen as a supply-side shock that would disrupt global supply chains, it entered Europe and North America, where it quickly became a demand-side shock, giving the Western world's economic dependence on the consumer at about 70% of GDP growth in the US and about 60% for Canada and globally. So given the timing and unprecedented drop, we went back and compared this to the average peak to trough declines for 6 previous recessions dating back over the past 50 years. What we found was that the average drop of negative 39% compared closely to this drop for the S&P 500 of negative 34%. However, the average duration of that decline was 487 days, or approximately 16 months, not 33 days. Clearly, the world moves much faster today than it did in the past, and arguably the S&P 500 being forward-looking adjusted much more quickly than it has historically. However, the magnitude of the decline was somewhat in line with the historical patterns. So in this next slide, we compared the level of valuation contraction as measured by the change in forward and trailing price earnings multiple over that same 33 days, and that's shown in the top clip here in green, the average valuation contraction over the same 6 previous recessions, which is shown in the bottom clip also in green. While the multiple contraction over the previous 6 historical recessions clearly took a lot longer, the actual average change at negative 38.6% was not that much different from what we saw in the 33 days at negative 30.5 and negative 33.9%. So it did raise the question for us back in March, just how much bad news was getting baked into the market, assuming we could rely on history as a benchmark for comparison. So the question we were faced with was trying to understand what kind of bear market or recession we were dealing with, given the unprecedented timing for all of this and the massive unprecedented fiscal and monetary response. The next slide we borrowed from Goldman Sachs report, which identified 3 types of bear markets. The first are structural bear markets, and these are the worst in terms of length, averaging about 42 months and the time to get back to previous highs. They're triggered by structural imbalances or asset bubbles, like we saw in the tech bubble in 2000, or the great financial crisis of 2008 and 2009. The second type are your run-in-the-mill bear markets, or your cyclical bear markets. They're a function more of the economic cycle and are usually caused by a tightening in Fed policy, which is often, which we saw in December of 2018, and again is usually associated with a tightening in policy like we saw the 4 rate hikes back then. The third type are event-driven bear markets, and they're often triggered by one-off shocks, such as emerging market sell-offs, a war, an oil price shock, or perhaps even a contagion like we have here today. None of these bear markets are particularly pleasant. However, in an event-driven bear market, which is what we have here, the average length and recovery time may be much shorter, which is the point we're trying to make in this slide. So that being the case, it seemed like a good entry point to possibly consider some names that were either overdone or perhaps not as affected by what was happening in the market. Also, we did get some comfort from the unprecedented fiscal and monetary policy response we were seeing, as well as seeing China begin to recover and parts of Europe seeing the curve flatten there as well. Also at that time, the market was extremely oversold.
So Pete, how is the portfolio currently positioned to take advantage of what's working today and what's overdone on the downside?
So Gerry, this slide shows the sector positioning for the North American plus international portfolio. Our large sector exposures are somewhat barbelled between what we'll call offense and defense. The offensive areas of the portfolio have held up pretty well or bounced back quite strongly, and in some cases, some of these companies are actually even benefiting from the COVID-19 pandemic. These include information technology, communications, healthcare, and you can probably throw consumer staples in there as well. We took advantage during the sell-off to add to existing names such as Microsoft and Abbott Labs, as well as initiate positions in new names such as Enghouse Systems, Global Payments, and MasterCard. And we'll have more to say about a couple of these in a minute. The more cyclically oriented sectors, being industrials and financials, we think they'll do well in a global economic recovery. And in some cases, we think some of these names just got too oversold, so we did some buying here as well. While they may take longer to recover, when the economic cycle does turn, we think that these stocks will do extremely well.
So Pete, as you said, there's been a chance to play both offense and defense in this market. Can you give us an example of an investment that takes advantage of the COVID-19 environment and one that has overreacted?
Sure, Gerry. So on this slide here, one new name that we purchased on the offense side in March was Enghouse Systems, which has a current market cap of just over $3 billion. Enghouse is run by its founder, chairman, and CEO, Steve Sadler, who also owns 14% of the firm. This company's demonstrated a consistent profitability with 5-year compound average revenue and EBITDA growth of over 6% and 10% respectively. It has done this through acquiring software and service verticals focused on government, healthcare, utilities, telecom, and financial services, such that its average return on invested capital over the past decade is approximately 29%. Now, currently, Enghouse balance sheet is fortified with $116 million in net cash and has no debt on the balance sheet. It generates over $80 million per year in free cash flow. Having spoke to management 3 times through the downturn, it expects minimal impact on revenues. In fact, we actually think the revenues may actually go up. So one of the reasons we think revenues may surprise to the upside is that last year Enghouse acquired a company called Video. Like Zoom, Video provides secure video enterprise software solutions with its direct verticals being hospitals and financial institutions. The purchase price was $40 million for $60 million of revenues, or approximately 0.66 times sales. The private market capital raised prior to takeout was estimated at US $170 million. Now, this next slide here shows a price chart for Zoom year to date, which many are probably familiar with. You can see here that it's more than doubled in value from about $19 billion to almost $50 billion. They've gone from about 10 million users in December to over 200 million users in March. So we took the opportunity to add Enghouse on the weakness in March with an average cost of just under $40 a share versus the current price today of around 58 bucks. Now, after we added Enghouse in March, Verizon Communications announced it was buying Video's direct competitor BlueJeans for between US $400 and $500 million, or about 4 to 5 times sales based on BlueJeans' annualized revenue run rate of about $100 million. Remember, Video was bought a year prior at 0.66 times sales. BlueJeans has also raised a similar amount in private market rounds at about 170 to 175 million, same as Video. So in terms of defense, Gerry, in this chart we compare the drawdown for Canadian banks during the great financial crisis of 2007 to 2009 of about negative 55%, which happened over a period of about 1.5 years, to the February-March drawdown of negative 40%, which took place over 33 days. The difference being the global financial crisis was caused by the banks, wreaking havoc on the real economy. However, paradoxically, this time it is the real economy that's wreaking havoc on the banks. The reality is the only sector of the economy that was financially prepared for this black swan event were the banks. And that's because they screwed up so badly in the last downturn, and they were forced by regulators to build fortress-like balance sheets. So this next chart's a little bit busy, but just focus on the red arrows and the red boxes. What it shows is that the consensus 2009 earnings estimates fell negative 23%, which is the left red box in 2008, and 6% in 2019 for 2020, and that's the right red box. As of last week, the consensus 2020 earnings per share estimates for the banks were now down negative 18% from 2019. However, the red arrows show the level of price earnings multiple contraction went from about 13 times to 7 times in the 2007 to 2009 financial crisis, and from about 12 times in 2018, currently to about 8 times 2021 earnings. However, bank earnings never fell 23% in 2009, and Canadian banks never cut their dividends back then either. When the market figured this out, the bank group rose 120% from February of 2009 to April of 2010. The same thing could happen today, maybe not quite of that magnitude, but we think in that direction. So in the next chart, we compare bank profitability and the dividend payout ratios during the great financial crisis to today. The top line looks at earnings per share growth. As you can see here, to sum up the negative growth rates in 2008 and 2009, they're between negative 10 and negative 11%, not even close to that negative 23% consensus number we showed you in the last slide. For 2020, the consensus estimates now, as I mentioned earlier, are negative 18%. Again, far greater than any year in the previous crisis combined. Yet, as you can see in the bottom line of this chart, even with these materially lower estimates, the dividend payout ratio for the bank group only rises from about 45% in 2019 to about 57% in 2020. And then it drops back to about 51% in 2021. Again, that compares to the 2007-2009 experience, where the payout ratio rose from about 41% to 51%. Not that much different. Now, part of the reason the profitability doesn't fall as much as the market may expect can be explained in this slide. This shows how much banks' trading revenue spiked from 2008 to 2009, up 129%. This was due to the increased volatility and credit spread widening through this period. And the exact same thing is happening this time. If you look at US bank reporting, their Q1 results came out a few weeks ago, and their capital markets revenue again spiked 54% in the first quarter. And that really only captured 1 month of volatility, being March, because their quarter was a January to March quarter. And as we've seen this week with the Canadian banks reporting, again, they're coming in yesterday, today, and the rest of this week. We're beginning to see that same type of trend showing up here. So what did we do at Cumberland? We bought National Bank during the sell-off in March, as we thought it was overdone on the downside. National Bank has the highest ROE, the Canadian 6 banks, at 18% in 2019 versus the bank group at around 15%. It also has the second highest capital cushion out of all the 6 banks to absorb future losses, and the lowest dividend payout ratio of the entire group. With a 5.2% dividend yield, it trades at a discount valuation to the bank group. This chart shows that our purchase and sale history compared to the stock's relative forward price earnings multiple. Well, we originally bought it back in the fall of 2017. It got quite expensive relative to its historical valuation, and it was sold out of the portfolios in February of this year. However, the sell-off presented an excellent opportunity to buy it back, shown in the chart. We actually did the exact same thing with JP Morgan, selling part of the position at $132 in late February, and recently bought it back at around $93. So to conclude, we were cautious selling down and raising cash in February as stocks got more expensive, but we're also adding back in March after that significant drawdown. Thanks, Gerry.
Okay, thanks, Pete, for the Canadian update. With that, let's turn over to Phil Diorio to give us an update on the U.S. markets and how he views the COVID-19 impacting on investing.
Thanks, Gerry. So in terms of how we're thinking about COVID-19 and the impact that it'll have, we've been spending a lot of our time thinking about the companies that we own across our portfolios. And the key question that we're asking ourselves is the investment thesis still valid? In other words, are the reasons that we bought the stock in the first place still valid today? And for some industries, COVID-19 won't change a thing, but there are some sectors of the economy that will be significantly impacted. Examples that come to mind include airlines, hotels, casinos, cruise lines, and almost anything that's travel related. Fortunately, our exposures to these areas are minimal. While some industry sectors will suffer, there are other sectors that should come out of this pandemic even stronger. And technology is one area that we're excited about. So I thought I would highlight some of the tech companies we own across our portfolios and discuss how they'll benefit as we move past COVID-19. So starting with Microsoft and Google. One trend that was already in place prior to the coronavirus was the amount of time that people spend on the internet. Another key trend was the acceleration of online transactions as e-commerce continues to take market share from bricks and mortar retail. With a large part of the world spending more time at home and more people working from home, we believe that these trends have only strengthened. And it's going to be a benefit for most of the platforms that are owned by Microsoft and Google. For Microsoft, it's a driver for their cloud business, Office 365, Xbox, and LinkedIn. And for Google, it's a driver for their internet search business, YouTube, Google Classroom, and Google Cloud. So now let's move on to payments. The electronic payments industry has experienced more than a decade of strong growth as the world economy moves away from cash and checks and increasingly to debit and credit cards. And while this transition is well advanced in North America, there are still many parts around the world, especially in Asia and Latin America, where cash and checks still represent more than 50% of consumer purchases. So there's still a long runway of growth for companies like Visa, MasterCard, and Global Payments. But given the emergence of COVID-19, we think that business fundamentals for these companies has become even stronger. An increase in online transactions will drive further use of debit and credit cards, simply because you can't use cash when you buy things online. And even when things go back to normal and people are back shopping in the stores, behaviors will change. Maybe not for everyone, but there'll be some people who would rather not touch dollar bills and coins when they can simply tap their debit or credit card. So all of this is positive for Visa, MasterCard, and Global Payments. So the business fundamentals are strong for these technology companies, but they also have tremendous balance sheet strength, and that's allowing them to reinvest in their business during this downturn. And that's a great place to be, because there's a lot of companies out there now who are scrambling to raise money in the bond market, while many others are fighting for their survival. Now, as you can see on the chart here, Google has over $100 billion in net cash. Microsoft has about $65 billion in net cash. And Visa and MasterCard have minimal debt levels of about $4 and $2 billion respectively. Global Payments is a bit of an outlier here with $8 billion of net debt, which is due to the fact that they just recently completed an acquisition. Now, when we're talking about financial strength, a commonly used metric is the net debt to EBITDA ratio. The average company in the S&P 500 has a net debt to EBITDA ratio of 3.3 times. Compare that with Google at -2, Microsoft at -1, Visa and MasterCard just above 0, and Global Payments, even though that one is higher, it's still below the average company at 3.3 times. So the point I'm trying to make here is that these companies are in strong financial condition, and I wanted to highlight them because they represent a good sample of our holdings that we consider to be the winners coming out of COVID-19.
That's fine. Let's move on. Healthcare is an important sector in the U.S. Can you speak to some of the attributes in the context of portfolio construction?
Sure. So healthcare is a sector that we like a lot at Cumberland. And one of the key reasons we like the sector is related to aging demographics around the world. There are over 1 billion people today above the age of 60, and this number is expected to double by 2050. So this is going to provide a multi-decade tailwind to healthcare companies, given that consumption of healthcare products and services rises significantly after the age of 60. So the fundamentals are strong, but we also like the sector because it's a highly profitable sector with one of the highest return on equity measures amongst all the sectors in the S&P 500. In addition, healthcare also has one of the highest growth rates and one of the lowest rates of earnings volatility. So we view the sector as a unique way to play offense and defense at the same time. And the stock market has taken notice of this, with healthcare being one of the best performing sectors in the S&P 500 over the long term. And it's accomplished that with lower volatility. As you can see on the chart, healthcare has generated a total return of about 8.5% per year over the last 20 years, making it the second best performing sector after consumer staples. And the volatility, as measured by standard deviation, is the second lowest amongst the 10 sectors in the S&P 500. So these are excellent risk-adjusted returns. And from a portfolio construction viewpoint, healthcare provides a lot of stability, and it's a great diversifier given its low degree of economic sensitivity. During this most recent market downturn that we had in March, healthcare was one of the best performing sectors, and that served as a reminder to us of its defensive characteristics and the importance that it plays in our portfolios.
So Bill, how are you positioned this large sector? You made any changes?
So in terms of our positioning, we own companies across the healthcare spectrum, including medical technology companies such as Baxter International, life science and tool companies like Thermo Fisher, and managed care companies, including United Health Group. And one thing that I'd like to point out here that's relevant to what's going on today is that 3 of the companies profiled here have recently developed diagnostic tests to help in the fight against COVID-19 and the spread of the virus. And so that's one of the reasons that we like these companies. They're very innovative, they're capable of delivering life-changing products to the market, and are able to do so in a timely manner. With regards to changes, what I'd like to do next is profile the most recent addition to our healthcare holdings, and that would be Abbott Labs. Abbott has a history dating back over 100 years. They have strong number 1 or number 2 market share positions across medical devices, nutrition, and diagnostics. They have a global platform that spans across more than 160 countries, and that includes some of the fastest growing emerging markets. And Abbott has all of the characteristics that we typically look for in a company. They generate robust free cash flow, they have attractive growth prospects, and a shareholder-friendly management team. Abbott also rewards its shareholders through dividends, which have increased every year for the last 48 years. And that puts Abbott in an exclusive group called the Dividend Aristocrats, which is a group of about 50 companies that have increased their dividend every year for the last 25 years. So we really like Abbott, and we believe it's a great addition to our portfolios. Thanks, Gerry.
Okay, thanks, Phil. Let's go back to Pete for a minute. Pete, we've seen a pretty significant rally in the market while the economic statistics are actually getting worse. Are you worried about this, and do you think maybe the market's gotten ahead of itself?
So, Gerry, as you can see in this chart here, you're correct. Both the S&P 500 and the TSX have rallied, but that was from an extremely oversold level, and as we mentioned, on the back of unprecedented fiscal and monetary stimulus, as well as signs that other countries were beginning to emerge from this pandemic. And notwithstanding the terrible economic state that many are forced to live in today, to some degree, markets do become desensitized and begin to look through the bad news. So in this next chart, and you can see on the contrary to what most people likely believe, extreme unemployment and very low GDP growth have actually been historically correlated with future stock gains, not losses, according to Ned Davis. And the reason for this is that typically when things are this bad, the Federal Reserve has had no choice but to use every tool in the toolbox to get the economy back on its feet. And that's what exactly they're doing today. And secondly, when everyone knows things are as bad as they are, generally it's priced in. This chart compares the S&P 500, which is the top clip here shown in blue, to periods of high and low unemployment, which is the bottom clip shown in red. And again, this graph goes back to post-World War II. As indicated in the bottom clip and on the right, the latest read on unemployment for April came in at plus 14.7%. However, as indicated in the box up on the top left of the chart, the average historical gain in the S&P 500 when the unemployment rate has exceeded 6% has historically been plus 13.7%. Now, on the next chart, we compare the S&P 500. Again, it's the top clip in blue to periods of very strong and very weak economic growth as measured by GDP, which is the bottom clip in red. Again, it's a bit counterintuitive. However, looking at the box in the top left, you'll see that weak GDP growth has historically been associated with strong double-digit gains in stocks. Now, clearly, the unemployment rate at 14.7% for April and estimates for Q2 GDP coming in around negative 30% are bad. However, the silver lining to this is that there is a lot of excess labor, excess capacity, and resources that could turn into non-inflationary growth in the second half of 2020 and looking out into 2021. Thanks, Gerry.
Okay, thanks, Pete. Well, let's change asset classes and go to Diane Pang for an update on the fixed income market.
Thanks, Gerry. So I'm going to start off with the central banks, as I usually do, and start with the Federal Reserve. The U.S. overnight interest rate is 0%, the lower bound after cutting 150 basis points in the month of March. They are expected to leave that rate there through to 2021 at least. Next, the Bank of Canada also cut interest rates 150 basis points year to date and has an overnight interest rate now of 25 basis points. They're also expected to hold in the near term at that level. The most obvious question is, are we going into negative rates? Well, both the Fed chairman and the Bank of Canada governor are against it. Tiff Macklem, the new Bank of Canada governor starting on June 3rd, has also gone on record saying he's comfortable with the rate where it is now. The central banks need to get companies through the pandemic, then reassess what sort of recovery we will see. So right now, the goal is to keep markets functioning and companies liquid. While both central banks have cut 150 basis points, the need for negative rates won't necessarily be effective right now. This is the first time in the history of the Bank of Canada that they have embarked on utilizing their balance sheet. So they are starting from a clean slate, and they have a lot of bandwidth to use this balance sheet to provide the needed liquidity for all levels of government and also companies. So when we're investing in fixed income, and in particular looking for income, we're looking at two things. One, the shape of the yield curve for positioning, and then credit spreads so that we can understand where the most value lies in terms of the asset classes within fixed income. So let's move to the yield curve. So this is showing you Government of Canada bond yields of 6 months out to 30 years. The purple line at the top is flat, as you can see. It's basically at the end of December 2019 is showing you that there was no difference in investing in a 2-year government bond, which is highlighted there as June 2022, versus a 30-year Government of Canada bond, which is highlighted there as December 2051. With the Bank of Canada's rate cuts in March, you see in the green line that this curve has gotten a little bit steeper. So now there's about an 85 basis points differential between a 2-year and a 30-year curve. So if you look at corporate spreads next, this is indicating the amount of incremental risk for being invested in versus a Government of Canada bond. The higher the spread, the more risk you're taking on because you're actually getting a higher yield. So if you're focusing on the top line, which is the blue line, and it's BBB rated companies that would fall into this category would be BCE or Rogers Communications. So at the end of March, spreads widened out as much to 295 basis points and has since then contracted to around 224 basis points. So you can see that it's still not back to levels before the pandemic where it was closer to 120 basis points. Obviously, the risk has heightened for some of these companies, and the risk pattern has moved in sync with A-rated or AA-rated bonds. Corporate spreads in Canada hasn't recovered as quickly as the U.S., but there is government support as the Bank of Canada is starting to repurchase corporate bonds in the secondary market to help provide liquidity. This has started their buying just yesterday. So with that, we expect spreads, that the peak of the spreads is behind us. And obviously, based on individual cases, the recovery of these spreads will differ based on their fundamentals. So I just want to put the last two charts together into this chart, which shows you what an investor would make in all types of all-in yields. So this is showing you for a BBB 5-year bond, your total yield as an investor at the end of 2019 would have been 2.86%. With the decline in interest rates offset by that increase in spreads, your all-in yields actually were higher at 3.5% at the end of the first quarter. Then it has further contracted back to levels that you saw in December 2019. So I just want to point out in the red arrows that spreads widened 173 basis points from Q4 to Q1, but has only contracted 52 basis points. It's only recovered 30%. Provincial bonds tells you a different story. Provincial bonds are rated better, and typically in an environment such as a pandemic, people are fleeing to safety. So yields, as you can see, all in, have actually declined over that same period. Spreads did widen between Q4 and Q1 by 48 basis points, but has recovered, tightening in 23 basis points. So that recovery is about 50% from that initial widening.
Thanks, Diane. So with that overview, how have you positioned the Cumberland Income Fund?
So let me talk about the duration and the yield to maturity. In terms of duration, we're still very short versus our benchmark. Our duration did increase from 4.2 years to 4.8 years. And that was only because there was a lot of bonds that had matured over the last few months. And we invested those into new issuance or things in the secondary market that we found more interesting. And that would typically be in the 5 to 10 year bandwidth sectors. Yield to maturity has also increased from 3.25% to 4.2%. benchmark has decreased from 2 to 1.5%. So our increase in yield is a combination because of that spread widening, but also because we were able to reinvest some of the bonds that matured into new opportunities and lock in the higher yield. The next slide I'm going to show you is the sector allocation. Obviously, I'm showing you from March 31st because that's where spreads were the widest. So I wanted to show you how we were positioned during the peak of the pandemic and our changes since then. So during that pandemic period, our portfolio was positioned at a 12% weight in governments. Government bonds are made up mostly of provincial bonds. So we were very defensive going in through the pandemic. And since then, we are taking that weight down of government bonds and reallocated into corporate bond holdings because we saw a better risk reward. We sold out our provincial bonds, specifically Ontario bonds, and reallocated into utilities, industrials, and some REITs, names such as Hydro One, CN Rail, and Choice Properties. Also, since the quarter, our asset mix has changed a bit. High yield has come down, combination because of prices has come down from high yield bonds, but also we had a big maturity that were paid out in early May that we had not reinvested into the category. So as a result, cash has gone up to 3% from 1%, and we continue to look for opportunities. So just to conclude that we've been very selective into finding good opportunities, particularly in the corporate investment grade space, and we're able to lock in better yields and still target that 3 to 4% yield that we want in the fund.
Okay, thank you, Diane, and thank you, other panelists, for your comments. Let's now go to the question and answer session, and I'm going to ask Charlie Sims to moderate this portion of the presentation.
Thank you, Gerry, Peter, Phil, and Diane for your comments. Just as a reminder, to ask a question, you have two options. There's a Q&A button at the bottom of your screen. If you click on that, you'll be allowed to type in a question, and we've received a couple already. There's also a utility on Zoom called Raise Your Hand. If you click once on this, it will notify me that you have a question, and you will be sequenced in so that I can call on you to ask your question to one of our panelists. While we're waiting for individuals to queue in and think about questions, we have a couple that I've received already, and I will ask them. The first one is, inflation has been a non-factor with huge central bank intervention globally. Do you see any scenario where there may be a loss of confidence in the currency central banks are printing? Gerry, do you want to open it up and then assign whoever you'd like to answer?
Sure. I think that's a true statement. I think there probably is going to be some loss of confidence because we're really going into unknown territory. The amount of debt that's being created is beyond anything we have seen in the past. You're getting roughly about $4 trillion in extra debt coming out of the United States on top of $1 trillion that was already budgeted for. So $5 trillion of debt going north and a $20 trillion economy is pretty substantial. There is no plan at this point to how it's going to be repaid. Everybody is simply fighting the pandemic, and how we're going to deal with the aftermath of all this financially is yet to be determined. So to an extent, the gold is a bit of a barometer on people's full faith and credit in the system. Whether you get more inflation or not, what you've done is by shutting down the economy, you've destroyed the demand side. You've got a lot of supply out there, so prices are coming down. If some of the supply goes away, like airlines either get together or we lose them and supply comes in, then there's a possible case that you do get some inflation out of this. But that yet remains to be seen, given that the government seems to want to support everybody. So, that would be the natural conclusion if you were a monetary theorist. That doesn't seem to work in the last few years.
If there's no other comments, we have another question. Phil, maybe this one is for you. Have you looked into investing into companies that are looking into vaccines for COVID-19?
So there are a lot of companies currently searching for a vaccine to fight against COVID-19. And the range of companies, goes from small startup biotech companies to companies as large as Johnson & Johnson. And I'd say from my vantage point, the more likely scenario is that it'd be one of the bigger, more established pharmaceutical companies that might end up finding the vaccine that ends up being the cure. And what will probably end up happening is that the profit from that will be small in relation to the overall profit of the company. In fact, for Johnson & Johnson, I'm pretty sure they've come out and said that they're doing this on a non-profit basis. So I'm following it very carefully, given my interest in the healthcare sector and just given what's going on in the world that's affecting all of us. But I have yet to find a way to invest in this for the portfolio.
Charlie, maybe I'll just add one thing. I mean, I'm just reading a note here. There's 10 vaccines that are in clinical trials right now and 114 in preclinical evaluation. So, I mean, it's almost like, wildcatting for oil. I mean, I think it would be really difficult to try and pick the one that's going to have the cure. And as Phil points out, even if you do, I'm not sure how much money you're going to make on it. So I'll leave it at that.
Peter, maybe I'll tap you for this one as well, and possibly Diane might have a comment. Have the announced government programs had, or do you think they will have the desired impact from your perspective?
Oh yeah, I think they already are. I mean, you're seeing it just in terms of the number of people that are paying rent. I saw one chart the other day. It was more U.S. oriented, but I think the same thing applies here in Canada. And they just showed, number of people that are paying rents this April and May versus last April and May. And again, it sort of runs somewhere in that 89 to 95% range. So I think you're getting the desired effect. Again, there was another study I was looking at that showed right now about 60% of companies in the U.S. have still got the same number of employees today as they did 2 or 3 months ago. So, and again, they're keeping them on because they're getting these programs, these incentives to keep them on, and again, they'll be forgiven as long as they keep those employees on. So I think you're getting the desired effect. Because the question is they came out with this CARES Act program, which was a $2 trillion program, is whether it's enough and whether they're going to need to come out with something else. And again, I know that there's another $3 trillion in the works. I think you're gonna need to sustain that long enough until either the economy starts to pick up naturally, or until we do have better signs of a cure here, Charlie.
Thanks, Peter. Diane, maybe you could comment, if you would, just how you feel some of the bond buying programs and the debt repurchase programs the government has put in place have helped or hindered the market in your view?
Sure. I think in terms of, they started with some more of the bankers that have some programs and T-bills repurchases, and then they've expanded their programs into provincial bonds and corporate bonds now. And we're seeing that that's helping issuance and helping refinance upcoming maturities for issuers. So that's been helpful, and it gives confidence to investors to be able to, that we have the government support, and they're also participating in new issuances with us also. On the corporate side, they just started buying yesterday, and they came up with a list of 61 different securities, and it's still trial and error, but they're open to tweaking their process. They only executed on 4 of the 61 securities, but I think it's going to be, this program is going to be open for a year. But it's been given confidence, as you see, the first list of these 61 securities were actually the sectors that were actually falling behind, which was the REIT sector and some of the energy names. So that was helpful to see. They had targeted the first 61 securities to be in those sectors that kind of lagged the most. So I think we're gonna see it improve, and we're gonna see more purchases going through, and we'll see that more responsible in the next coming weeks.
Great, thank you, Diane. Phil, the next one's for you. Given the view on cashless society, interest in global payments, MasterCard, etc., do we have any thoughts on Bitcoin or any of the other alternative currencies from our own investment thesis?
So I've read quite a bit about Bitcoin in the press. I do not want to pretend that I'm an expert on Bitcoin. It's interesting. I know one of the arguments for Bitcoin is its ability to be a better store of value versus fiat currency, given all the printing by central banks that's gone on over the last decade or so. Hard to say. I mean, I think it's still early days, and there's still a lot to be determined as to whether Bitcoin becomes accepted as a mainstream payment form. So I'm watching the developments, and I'm interested in it, but I don't have any strong opinions at this point.
Great, thanks. Alex, do you have a question, please?
Yes, we had one question come in just further to your comments on real estate and energy. How much exposure does Cumberland actually have on the equity side to the real estate sector and to the energy sector, which are both viewed as potentially vulnerable at this time? And maybe you can comment on the fixed income side as well.
Well, I can speak to the equity side. Our overall real estate exposure is almost zero. On energy, we're currently sitting somewhere between between 1% and 2%. We brought that down considerably back in January and February, just, you know, at that time, again, it was more the supply side issues we've seen with what's going on with egress and everything out. As it turns out, it's become more of a demand side shock now with the whole issue around COVID. But even if the economy picks up and demand picks up, I still think we're going to be dealing with the issues around supply side on oil. You know, at $30, companies basically break even. At $50, they can start to make a bit of money, but that's when the supply side kicks in, and you've seen it in the U.S. where production's gone from 5 million to 13 million barrels a day on the back of oil shale development. So I just don't see that situation changing. And the bottom line is the U.S. doesn't need Canada's oil or Saudi Arabia's oil anymore. So you're going to continue to see these issues around OPEC and Russia stepping up production, even if they show some discipline in the short term here to get prices back up. It'll just recirculate. So I can't get too bullish on that. I guess on the downstream side, we have one name in the portfolio, Parkland. I'm somewhat more positive on that right now, but so I'm okay with the downstream producers. They've got other sources of income as well, but not particularly bullish on energy.
Phil, we have a question for you. You didn't give us any slides on the international fund. Do you have any broad thoughts related to the fund or the international markets?
Sure. So one thing about the international fund is the exposure there is more geared towards Europe and Asia and other emerging markets. And when I compare those countries in those regions relative to the US, there's a lower bar in place. Europe has been in an economic funk for a very, very long time. Asia and many emerging markets have had challenges to deal with in recent years. Strength in the US dollar has been a headwind, weak commodity prices, and trade war recently as well. So I think the bar is low, and if those tailwinds, even if one or two were to go away, I think there could be the potential for a better recovery there than the U.S., which has actually enjoyed a pretty good recovery over the last 10 years since the financial crisis. So we do own some fantastic companies in that fund, and I think I'm really excited for the potential of those companies if a few things were to change in Europe and in Asia.
Great. Gerry, I got excited when I first started reading this question, but you may want to punt it to Peter. With the U.S. election coming on shortly, how is the Canadian oil exposure possibly going to be affected with any potential outcome there?
Well, I think it's probably a better question for Peter, because it's pretty industry specific.
Yeah, I mean, happy to take that. The Democrats, if they get in, I think Biden's come out and said he's gonna do what he can to cancel any pipelines, any more egress that could potentially grow into the U.S. So I don't see that as a positive. The reality is even with the Republicans in power, that you just haven't seen anything really move. I mean, we're still getting bogged down in all kinds of administrative red tape, whether it's at the municipal or state level. So I just can't get that positive on that whole egress issue, which is one of the reasons why I just can't get my mind around wanting to have large exposure in energy right now. Now, it doesn't mean it's the end of Canada. Energy is less than 10% of our GDP. It's a big piece, but it is less than 10%. So, I don't think it's going to necessarily kill the Canadian economy. But what we really need to see east and west egress. And again, that falls on the hands of our government up here. And until we have that, I think it's going to be a tough slug seeing any real growth in that sector.
Great, thank you. I have a couple of questions I'll combine here. Both relate to the recent rally in equity prices. Markets recovered much of its losses from the coronavirus lows. Do you see a risk that the market could retest those lows once the true impact of COVID-19 is known? Or what's your thought on the probability of a correction? Two questions from different attendees, but very much related.
I mean, I think, if you go back to where we were sort of prior to the COVID pandemic, the market was expensive. It's trading around 19 times earnings, but it was 19 times what I'll say, Charlie, our peak earnings. We were running almost at 180 forward earnings. Today we're running at forward earnings around $140. We're no longer at peak earnings. Now, the multiple arguably is at 21 times, but it's at 21 times what arguably I would say is probably trough earnings. 2020 is looking at 126 and looking out to 2021 around 163. So that's how you come out with that forward number around 140. But it is leveling off. I guess, when I look at whether we're going to retest the lows, I think it'll come down to how fast this economy turns around. I think there could be some digestion if we get some bad news on the vaccine progression or second wave. But what we're seeing right now is the economy is beginning to show signs of improving. I sat on all the bank calls this week, and again, most of them pointed out that things were the worst around the first week in April, and have generally gotten better going into May. So assuming that the economy does start to normalize, then people and the market will start moving towards that $160 to $165 2021 estimate. So if you think about it, every day that we move forward towards that estimate, that forward earnings number rises. And so that multiple will continue to come down. So on next year's earnings, we're around 18.4. Still not the cheapest multiple I'd like to see, but not bad. In March, as I showed in the chart earlier, we hit trough earnings and we hit a trough multiple around 13.2 times. I just don't think, and that the market's going to go back to that level again. That could be wrong, but again, there's other factors that come into play. We've got the largest short position we've seen on record right now in recent weeks. M2 liquidity, we've got QE forever, so we've got a backstop from the Fed. And again, the market is a bit bifurcated right now. We've had very strong earnings come in from some of the FANG stocks and things like that. But I think if that forward earnings estimate is troughing and it is showing signs of moving higher here, you could get a shift from sort of that quality FANG type stocks into the more value names, and they typically do run when we see a cycle trough in earnings, and I think that's where we're at. And that's kind of the reaction you've been seeing in the market the last couple of days. It's not really, the leadership is not in the technology space anymore. It seems to be shifting more to those sort of cyclical areas I was talking about, like industrials and financials. So hopefully that answers your question, Charlie.
I think there was a second part. Gerry, did you want to add anything?
No, I think Pete's onto it. I mean, there's been a dichotomy in the market, and if the growthier names, the FANG stocks, had continued to drag the averages higher without some broadening, then I'd say for sure, it's we're going to have a big correction, and you now are seeing some of these other groups start to participate. So, you look at the bank stock today, which are the poster child for value. They were probably the best performing group, and maybe one, if not, or only two of the FANG stocks were in fact in positive territory in the market. The Dow was up over 500 points. So whether we retest the lows, a lot of that's going to have to do with the coronavirus. If we open the market up or the economy up, and we have another flare up this fall, and the government reactions to shut the economy down again, I doubt that they would do that. But if they did again, then yeah, there's a good chance you would retest the lows. Will we have a correction? I guarantee it. One of the few things I can guarantee, but in the market for 50 years, the market always goes up and down. And so it's just a matter of time before you have some kind of a correction. And right now, the market's operating on two theories. One is don't fight the Fed, and that is this is temporary. Tomorrow, everything looks better than it does today. That's being reflected in the market, and the valuations are getting away from us a little bit on the high side. There'll be a reality check here at some point. You'll get a sell-off in the market. Things will sort itself out. You won't have missed everything if you got a little bit of cash. You'll have a chance to redeploy it. But I don't necessarily think it's going to go back down to the March 23rd lows.
Great. Do you foresee interest rates to go negative? And if so, what are the implications for the greater economy?
Well, I guess currently right now I don't see in the near term. I guess in the long term, if you look at other economies that have used it, it hasn't really helped. And so, look at Europe and Japan. And so if the U.S. goes into negative interest rates, pretty much every economy will have to also, because they just have to follow through, because the U.S. is used as their peg of foreign currency. So my view is that in general, negative rates don't actually help, and actually can do more harm than good. And for instance, you just have this mindset with people thinking that rates are never going to go higher, so it's actually more of deflationary than it is inflationary. And then you're also forcing a lot more savers that are trying to save for retirement to either take on more risk or to actually not spend at all, just because they need to save more, because they're not going to get anything back for their money. And then lastly, the last point is probably it's harder for financial institutions to be as profitable. They might not be lending as much. This is not going to help businesses gain access to the capital that they need to grow and expand. So that, even though businesses might want to borrow at negative rates, right? So that's not going to necessarily be helpful. So I don't see that to be the first, I guess, to be the next move of the central banks. I think the next move of the central banks would be just continue to expand their balance sheets and provide more liquidity into the market. And there's other tools that they can use outside of a negative rate tool.
Great, thank you. Peter, maybe I'll ask you to start on this one. The question is, do we have any thoughts on the move of production back on shore from the emerging market countries, and China in particular? Do you think it'll happen? And do you think that we have any companies in our portfolio that might benefit?
Charlie, I'm not an expert in that area. I think it definitely will happen. I mean, I think it was beginning to happen just prior to the whole COVID-19 situation. I think companies that had production over in China, I think were concerned about having one exposure there, and if nothing else, we're looking at least diversifying their exposure there. possibly in the U.S. I think that would be what Trump would like, but at least into other countries, maybe other Asian countries. So I think that was already in motion. I think what the whole pandemic just sort of showed is that perhaps things had gone too far in the direction of PPE, in terms of producing vaccines, and in terms of the components that go into PPE or into drugs that could help fight the COVID-19. And I think they realized that there's certain things that need to be produced in the United States, so or at least in North America. So I could see that happening going forward. I'm sure out of this there'll become a plan that makes sure that all the things that we needed are produced in North America. The problem is that the next Black Swan event won't be this, Charlie. It'll be something else. So
Always seems to be the case. Phil, did you have anything to add from your perspective, concentrating on international and U.S. securities?
Well, in terms of this onshoring, there was an announcement just a little over a week ago about Taiwan Semiconductor announcing that they're going to build a semi facility in Arizona for $12 billion. And so, this is one announcement. There's been many. And I think with what's happened here with COVID-19 and the impact that it's had on supply chains around the world, I think it just sort of is another driver to that trend to want to make sure that supply chains are diversified. And that trend towards onshoring in the U.S., I think, is going to continue. It's on the political agenda, but there's other factors that have come into play now as well.
Great, thanks. I just remind attendees that if you have a question, raise your hand or send me a written question. Peter, this company's been in the press, Shopify. Maybe you could touch on that company as it relates to Cumberland's investment process, and why we may or may not have that in the portfolio.
Sure, Charlie. It's been eating my lunch and my performance on the Canadian portfolio. But the last couple of days, it's dropped quite materially. As you all know, we have a process here, and essentially we have I'll call it an investable sandbox of companies that we invest in, and as a result of that, we require the companies to have a certain level of return on equity and return on invested capital. And they have to be over that threshold of return on equity and return on invested capital, and they have to maintain a frequency over that threshold. So it does narrow down the number of companies that we can buy, but I guess the positive news out of that is it keeps us from getting into trouble into too many names. And since we've sort of employed this strategy, we've had very few drawdowns in the portfolio. In the case of Shopify, the company, it doesn't make money, Charlie, so it just doesn't meet our screening criteria. We have other screening criteria that it would pick up if it had the prospect for making a profit, but it hasn't hit those thresholds yet either. So it's just not on our investable universe. Having said that, there are a lot of great technology companies that we have in the portfolio. I mean, our weighting in technology is over 20%. So it's not like we're not in the sector. We just don't own that particular name at this time for those reasons.
Great, thank you, Peter. And Phil, there was another specific question from one of our clients around the company Square. You talked about the payments process. That's a business that participates. Do you have any thoughts around that, again, with respect to our process as a context?
Yes, I'm just going to actually reiterate what Peter said. There's a process in place, and for us to have a company considered for inclusion in the portfolios, they have to have a certain sustained track record of profitability. And Square actually just became profitable in 2019, so they don't make it into our universe of investable security. So I'm familiar with it, but I haven't spent a lot of time on it, because even if I really like the company, it doesn't meet our criteria.
And then we have time for a couple more questions. If there are any, please feel free to submit them. We have one question that if we had dollars to invest today with Cumberland, where would we guide you to invest? And I think maybe I'll take a stab at that and then have any of my partners jump in behind me. The most important thing for us is getting an understanding of your needs, what your time horizon is, where you're invested, and what your preferences are. And that's the work of our portfolio manager team that interacts with clients. So it's really important that we have that discussion and follow up. We're blessed that we have many different strategies, whether they be on the income side or the equity side or a combination thereof, that can meet multiple needs of our clients. And so we would encourage you to reach out and have a conversation. If you do have questions about the market, as you've asked us today, and the levels or what might happen in the future, or if you have dollars to deploy, or quite frankly, if you'd like a second opinion on investments that you have in your portfolio, our team would be more than delighted to have those discussions with you. With that, I'm not seeing any other questions up on the screen at this particular point in time. Gerry, maybe I would turn it back over to you to conclude.
All right, so that does conclude our question and answer session. We thank everybody for joining us and hope that we've provided some constructive background on the markets and how we intend to take advantage of today's market environment. So thank you again for joining us. This concludes our presentation for today.